And there it is, the closing bell at the New York Stock Exchange. The Dow Jones had an up and down day ahead of the Fed's decision on interest rates, finishing the day relatively flat. It's up more than 50 points.
The Nasdaq and S&P both hovered between positive and negative territory. The S&P finished just about 0.5% up, while the Nasdaq is up around 0.25%. Joining us now is Brent Schutte. He's a chief investment strategist for Northwestern Mutual Wealth Management Company. Brent, welcome. Great to have you with us. So tomorrow, the Federal Reserve is expected to hike interest rates 50 basis points. Now, that would be the first time we've seen a hike that large since 2000, but we have known that this latest hike was coming for a while. So what do you make of it all?
Yeah, I mean, to me, tomorrow people are going to be looking to see what does Jerome Powell have to say from the standpoint of what does he expect in the future. So if I think between last meeting and this meeting, the market has priced in an additional 1% in rate hikes. And I think people are going to be interested in seeing if Jerome Powell pushes back on that or if he indeed endorses that. You mentioned that this is expected. To me, this is the most expected Fed tightening cycle that I have seen. And so if you think about it, markets have already priced in the reality that the Fed will be tightening rates over the next year. That is already priced into current prices. And what happens now in the markets is how that differs. And that's where we still have an optimistic outlook that the Fed won't have to tighten as much as what is currently priced in. And that will eventually lead to a market that is pushed higher by that a little bit easier policy than what people imagine is coming.
Hey, Brent, as you know, unemployment rate is at an historically low level. How might that complicate raising interest rates?
Well, that's where I think there's some worries here. And I do believe there's still room left to run in this economic cycle in the market. But the question is, how many more people can we bring back into the labor market? And so the unemployment rate only calculates people who are actually looking for a job. If you're not looking for a job, you're not unemployed. You're just not looking for a job, and you're not counted in that 3.5% unemployment rate. The question going forward is going to be, can we continue to bring more people back in to fill those open jobs and have supply keep up with demand? There's good news. In the first quarter, we added 2.1 million Americans to the labor market that weren't looking for a job. That's what we're going to need to keep this cycle going, and that's where we think there is still some positive data to still come.
And so I want to ask you about something else, Brent. The Federal Reserve is also expected to announce a new program on Wednesday to minimize its stockpile of Treasury and mortgage bonds. You know, what do we know about this program? What should investors know?
Yeah, I mean, it's largely priced in. And so the Fed did release their expectations of how they're going to do this in their March minute. The Fed likes to pre-announce these things and get people to kind of adapt. So markets have already adapted to it. I mean, the question that investors have to ask themselves is how much of this is already priced in? Look, this is a Federal Reserve that is different than the Federal Reserves that I've seen in my 27 years of doing this. This Federal Reserve loves to come on TV shows and talk about what they're going to do. In the past, we had to sit around and wonder what they were going to do, and the market had to figure it out. Now they are out launching trial balloons on a daily basis. And I think the good news for investors is markets have priced a lot of this in. And so I get questions from investors saying, what should I do with my bonds now that the Fed is going to be tightening? My answer is it's already reflected. The 10-year Treasury has gone from 22 basis points in October to 275 today. That reflects a lot of potential tightening, and any deviation from that is where we're at in the future, where the margins will be had. And right now, investors are already pessimistic about these outcomes that could occur because of this. And that's where I think there's some room for optimism in the future.
All right, we'll be watching what the Fed does tomorrow. Brent Schutte, thank you.
Thank you.